now like to have a panel discussion, and I'm very happy to say we've got a very distinguished panel joining us today. I'd like to invite our panelists to join me on the stage. First, you've already met Foo Peng Er, who is Vice President of Environmental Health and Safety at CapitaLand. She is also currently a board member and the Assistant Secretary of the Singapore Green Building Council. Peng Er works closely with the various strategic business units in the CapitaLand Group to implement CapitaLand's environmental, health, and safety management system, which is externally certified to the ISO 14001 and OHSAS 18001 standards. And Peng Er also works on group-wide stakeholder activities, as you've just heard, to engage with tenants, residents, contractors, vendors, and staff to join CapitaLand in their sustainability journey. Peng Er spearheads the publication of the CapitaLand Sustainability Report, providing transparency to the group's environmental, social, and governance performance. She works closely with corporate communications and investor relations colleagues to communicate sustainability issues and initiatives to stakeholders. Nick Chukiat is an analyst at the Global Real Estate Multi-Managers team at UBS Global Asset Management. In his role, he is responsible for undertaking research and analysis of Asian real estate funds for the Global Real Estate Multi-Managers team and their mandates and segregated accounts. In addition, Nick is involved with various portfolio management activities. And prior to joining UBS Global Asset Management, Nick was an associate director at AEW Capital Management, where he was most recently an acquisitions officer for AEW's Asia-focused value-added funds. Nick has also worked in investment in Boston and New York. Next to Nick is Nina Reid, who is the global head of responsible property investment at M&G Real Estate based in London, where she is responsible for managing the ongoing development and implementation of M&G Real Estate's global responsible property investment strategy and environmental reporting programs, by further embedding sustainability into the investment decision-making process. She oversees a wide range of sustainability projects, including energy management, environmental risk management, and sustainable investment. Prior to joining M&G Real Estate in 2011, Nina was an associate director with the upstream sustainability services team at Jones Lang LaSalle. Nina brings us valuable insights from Europe, where we've seen are really leading the charge in sustainable real estate development, and where legislation supporting sustainable real estate is arguably becoming among the strictest in the world. Amanda Steele is my colleague and head of sustainability for CBRE at Pacific, and Amanda oversees the provision of our sustainability consulting services to investors, developers, and occupiers in Australia and New Zealand. Amanda has considerable experience in working with leading organizations on sustainability strategy and delivery. She has worked with many organizations listed as Dow Jones Sustainability Leaders. Amanda brings over 15 years of work experience in sustainability to CBRE, and she has worked with the highest levels of government, nationally and internationally, and has enjoyed working alongside many boards and CEOs of different organizations. Her strengths lie in integrated solutions to persistent problems across the environmental, social, and economic spectrums. And Amanda is also the author of several sustainability reports, many of which have won national awards. And last but absolutely not least is Ben Towell. Ben is an officer with the BCA Green Mark Department, where he works to develop various criteria and assesses buildings and districts for their environmental performance, both locally here in Singapore and overseas. His role with the BCA extends to giving lectures to international policymakers and working within joint agency sustainability and planning studies and global professional bodies. Benjamin was part of the BCA team that developed their recently released Green Lease Toolkit and is currently involved in developing the future version of Green Mark for new buildings, version 5, as well as investigating environmental policies around the world and advocating a roadmap for green schools. Ben is also chair of the World Green Building Council Rating Tools Task Force Group and will give us some important insights from the government sector perspective. So thank you and welcome to all the panelists today. The sustainability reporting movement has been driven largely by the demand from institutional investors for greater transparency and the ability to consistently benchmark and compare performance against environmental, social, and governance aspects that are important to the investment decision-making process. This very much holds true for GRESB in the case of real estate investment, which discloses the performance of funds to their investors. In addition, we're seeing increasing demand from certain occupiers who have sustainability policies and performance targets linked to their real estate portfolios, as well as more government regulation, particularly focused on improving the environmental performance of buildings. I'd like to start this panel discussion with Nick and ask about the institutional investor sentiment for sustainable property investment in Asia Pacific. From your colleagues and your peers in the industry, what are the key things that you are looking for in terms of performance from the funds that you invest in? And from your perspective, what are the drivers in those requirements? And then finally, how do you see that evolving over the coming years?
Thank you, Tim. Firstly, in my role as a multi-manager, we invest in real estate funds, unlisted funds. So from our perspective, we decide who to put our money with, and we let them implement the strategies that they've outlined to us. So at the end of the day, we are limited in how we can actually get sustainability implemented. However, we are able to select managers who we believe are best placed to implement sustainability strategies. So as our evolving process is standardized, we have a standard due diligence questionnaire that we always send to our prospects. That standardized questionnaire, we'd like to believe, is better than the market. However, or just namely, we want to know who in an organization is responsible for sustainability matters. What are their qualifications? We also want to know what regulations and legal frameworks each of the funds is regulated by, so that we know whether the funds are just doing enough to get by or whether they are doing above and beyond what's required of them. And then we also want to know what they're doing on the ground. So in terms of providing us examples, providing us case studies, those are all things that we are looking for. I think right now what GRESB is doing is helping create a system by which we can actually quantify what each of the managers is doing. But I think, quite honestly, right now, the only way we can measure performance is to understand what it is the fund managers are saying they will deliver and measuring their performance by their actual ability to deliver on what they're telling us. In terms of quantifying what they've been able to do, it's much harder. And I think we are looking forward to working with GRESB and other industry bodies to implement more rigorous and quantifiable performance standards.
Thank you. Nina, you're based in the UK, and M&G Real Estate have a number of funds in the UK and in mainland Europe, which is home to some of the most progressive, sustainable focused institutional investors in the industry, and part of the reason why GRESB comes from Europe. To the extent that in Asia we might look at what you're seeing from your investors in Europe today as an indicator of what we should look to expect here in Asia in the next couple of years. What have been some of the key investor trends that you've noticed in the UK and Europe over the last couple of years? And also, how key has some of that EU and UK legislation around sustainable real estate been in driving what you're doing with sustainability and M&G?
Thanks, Jim. Yeah, I think with respect to sort of growth in investor interest, I would say over the sort of probably past 5 years or so, there's been sort of significant sort of uptake and interest from investors. It's fairly standard now to see some form of question within any RFP about our sustainability policy and approach and management. Generally we're asked, are we a signatory of the Principles for Responsible Investment? Increasingly, we're also asked, are we a participant in GRESB? What's our score? We're also getting increasing questions from our investors who are already invested in our funds around specific risk areas. And I think in part that reflects the regulatory risks that we're facing. So, and some of the regulatory risks potentially have quite a significant impact on our investment decision making now. So in the UK from 2018, we could potentially be banned from letting poorly buildings with a poorly rated energy performance, which is obviously having a significant impact already in the UK in terms of investment decision making. So it's being factored in when we're looking to acquire assets as to what the energy performance of that asset is and how we might go about improving poorly performing buildings if we are going to buy them with a poor rating. So, and that in turn goes back to investors are now asking us questions about what's your portfolio exposure to these risks. We had flooding events last year, so we had investors asking what's your exposure to flood risk, how many properties were flooded, what's your plans for managing that. So some investors are asking us very specific risk questions. I would say on the whole it's still fairly simple at the moment. We haven't been seeing any sort of mandated standards from our investors yet, although we are starting to hear of that happening in the marketplace, but I would say it's very early days on that. But I think we see that as potentially being the direction of travel, particularly from some of the mainland European institutional investors going forward. So I think regulation sits behind a lot of the investor interest because they see the direction of travel. Europe set out its stance that by 2050 we need to see an 80% reduction in carbon emissions, and the built environment by 2050 will need to contribute basically no net carbon. So we will have a lot of regulation on the built environment who's seeing as a low-hanging fruit to delivering that for Europe to be able to achieve its goals. So we know that there is going to be a lot of regulation coming forward over the coming year. And I would say that we're seeing that trend not just in Europe, but increasingly in the US, Canada, being driven more at a city level, and obviously in various standards in Asia, Pacific, and Australia as well, notably. So.
Very good, thank you. Peng Er, CapitaLand, as I think everybody knows, has some of Asia's greenest building projects, and where in some cases there hasn't been a particular investor or regulatory pressure, like we've heard already, to drive the particular attention that CapitaLand is placing on sustainability. And so to that end, what are the sort of drivers to sustainable building development and ownership is CapitaLand seeing in Asia?
In our company, maybe we'll share from our experience. You're right. In the beginning days, there was no regulation. There wasn't a demand. People didn't really understand what it was. But it was the founding principle of the company that our credo is building people and building communities. So we knew we wanted to build buildings that would benefit the community, and that was the starting point. So when Green Mark was launched in Singapore in 2005, it wasn't mandatory, but we got on board immediately, and our flagship project got Green Mark. So I think it was a top management commitment to embark on this journey. Whereas the audience is about investors. So maybe I'll come from a risk management perspective and opportunities perspective. Because we started on this journey right from the onset, we took the perspective that we want to future-proof our properties. And some examples are very clear. When Green Mark was launched, it wasn't mandatory, but we created an internal benchmark in our green building guidelines that we must achieve Green Mark certification. So when it was mandated, it wasn't a problem for us. What we needed to do is raise our benchmark. So now it's Green Mark Gold Plus as a minimum requirement for Singapore. We had been tracking our energy, water, waste, and we had to figure it out how to do it. Can you imagine our portfolio over 20 countries, different property types, service apartments, malls, homes and offices? It took us quite a while to understand it. But because we had that time to learn and understand, when it was mandated in Singapore to report energy, it wasn't a problem for us. We knew where we were, and we didn't need to scramble. And now it's mandated for waste management for our big shopping malls. But we have the data, we understood the data, and we're already talking to the tenants. I think from our perspective, it's taking a longer term view on this. Our buildings impact the community, and it will be cheaper to build it right in the beginning, rather than having to retrofit to meet a regulatory standard that comes along the way. And exactly in Asia, you're seeing a lot of climatic issues, and we believe our buildings are ready for it. So that is the story we want to say.
Thank you, Peng Er. Ben, you represent arguably Asia's leading governmental body on sustainable real estate. And Singapore's target to have 80% of building stock certified under Green Mark by 2030, and the regulations in place now to facilitate that are, I think, truly game-changing from an Asia perspective. Part of your role at BCA is to engage with your counterparts in other Asia governmental bodies. And so through those discussions, what sort of government drivers are you seeing, or do you think that we can expect for sustainable real estate ownership around the region in the next sort of 5-10 years?
Well, a lot of the policies, especially around sustainability, are in tension with the economic state of those countries. So some of them are really trying to grow their economy, through the normal capitalist means, whereas others have, like Singapore, a bit more luxury. The economy is quite stable, so they're still trying to grow it, but there's time and effort to look at the more sustainable strategies, so to speak. The key drivers are what we're seeing quite similar. A lot of it starts with incentivizing green buildings, mostly new developments, to be honest, as they're the easiest to do because they haven't been built yet. So we're seeing a lot of regional rating tools being created in those countries, policies very similar to what we have in Singapore and very similar to European policies and Australian policies, as they always form a great term of reference. So in some countries, the incentives form a form of tax relief, and others it is bonus gross floor area, which is also quite common in the region. But the issue is existing buildings still aren't gaining much traction, especially in the rest of the region. In Singapore, see, there's the constraint that our national boundary is very small, so existing buildings will happen, but in places like Malaysia, Thailand, etc., they can just sprawl outwards a little bit, build a new building. I've got whichever certification I've chosen, therefore I meet the mandate of whichever corporate headquarter or investor who says they want something sustainable, which inherently is not the right way of doing it. So the key issues we're seeing are regionally, and I think it's a global issue, is how do we do that with the existing buildings? And that's where investment and those large property owners and REITs actually do play a big role themselves in saying, well, actually, instead of having a new building, can we use what's already there, and how do we retrofit that which is actually cheaper? So the key drivers currently for ownership are skewed towards new buildings regionally. That's what we're seeing.
Thanks, Ben. Amanda, we've been talking about Pacific a lot this morning. It's home to many of GRESB's green stars, as Ruben's told us already, and also, whether it's the government or some of the big Australian corporations, some of its greenest occupiers as well. I think most people here have some awareness of the key influence that government policy and regulation in Australia has had on that transformation that we've seen in the real estate industry. And again, I think there's a sense that many Asian countries will look to see what has worked in Australia in making that transformation and look to adopt that. What's driving, from your perspective, sustainable real estate development, investment in existing buildings in Pacific today, and what are going to be those big drivers or big factors that owners in Pacific are going to look to when they're driving to the next level of what they're doing?
Thanks, Tim. And thank you for Ruben for just highlighting just how well the region is doing in Australia and New Zealand. I had to throw that in. I apologise to everyone in the room, except for the Australians who are smiling at table number 2. NABERS has certainly been a big driver in the regulation space in Australia. And for those who don't know, it's a regulation that was brought in. What came behind the regulation was that the Australian government had a commitment to only be in 4.5-star NABERS rated buildings. They occupy 30% of the office market in Australia, and I'm sure, unlike most other governments in the region, Australian governments are very good at work-life balance. They're a fantastic tenant. They take a long-term lease of about 10 to 15 years. They always pay on time, but the work-life balance bit is beautiful for energy profile because they start at 9 and they finish at 5. So they're a fantastic tenant to have in a lot of ways. It's certainly been a big driver, and it's certainly been a fantastic tool. It's been an elegant piece of legislation, which is something I don't usually say about legislation. But the regulation piece that sits beside it has allowed an adaptability. It's adapted to changes in the market. And that's been a compelling piece of why it's been so successful in Australia. But before NABERS, we also had Green Star, and that has also been a big driver in the market there. That tool has evolved over time as well, and we've seen a lot of our large landlords and tenants demand that in the market in Australia as well. So I don't think we can really separate NABERS and Green Star from each other. They've both had their role to play in the Australian market. As for what's driving that investment in sustainability in Australia, it's really quite self-serving. Sustainable buildings, buildings with a good green accreditation, are seen as good quality buildings. It's a proxy for quality. As energy prices continue to escalate as well, of course, the cost drivers are there, and we've seen portfolios where that energy cost is actually hitting the EBITDA. So when that happens, all of a sudden those portfolio owners are very conscious of improving their ratings and their standing. So that continues to be a driver in the Australian and the Pacific market. Other areas that we'll see emerge in the region going forward, and Tim, we were talking about this yesterday, is absolutely supply chain. That's a big driver, and it's something that CBRE are working on, and how to assist our clients in that space. And that impacts the way the building is run, the way the building is managed, and the way the suppliers are working within that space. So I think they're the drivers that we'll see going forward.
Thanks. A perennial challenge to the successful implementation of many sustainability programs and initiatives is the ability to understand the value that those programs and initiatives derive to the business, to ensure that they're practical economically as well as environmentally or socially beneficial. In the most basic terms, this is often illustrated by the issue of return on investment for investing in energy conservation measures. The investment strategy for an asset can often have a profound implication on how sustainability ends up being implemented within that asset and therefore by extrapolation within portfolios. Nina, while all of M&G's funds are open-ended funds and therefore you have a longer-term outlook on your individual assets, do you ever experience challenges with sustainability in those sorts of time horizons within M&G's responsible property investment program? And if so, how do you overcome those? And also like to ask your perspective from the broader industry in Europe. Do closed-end funds appear to struggle with the issue? And if not, how do they get over that?
Yeah, it's an interesting question. I think that definitely the length of time that we plan to hold an asset does have by necessity an impact on our decision making, because I think it's, and obviously leases are structured in different ways in different regions and different markets, and the UK is different from Europe, and know that there's different models in Asia and Australia. But one of our biggest challenges is who accrues the benefits from implementing measures. And more often than not, it is our tenants that would accrue the benefit from us spending money on improving the building. And that is a big challenge, and it becomes even more challenging if either we are looking to sell the asset within a relatively short time frame, and or the tenant's lease is due to sort of expire within the next few years. And then you have to consider factors such as, does improving the asset would it help or hinder the sale of that building, and or is it going to help you attract new tenants if the leases are going to be up? So on an individual basis, you have to sort of factor that all into your decision making, and it definitely does have an impact if you're looking to hold the asset for the short term. I have to say that that is where perhaps the legislative framework supports that, because I think there's now an obsolescence driver in the back of your mind. So obviously as an investor, if you think that you can improve the building more cheaply than you would if you got price chipped for having a poorly performing building, then there's a driver for you to make those improvements yourself. I think also if the legislative framework is clear in terms of where it's going over time, you might decide to make a more significant investment now to future-proof it against further changes in legislation. So a lot of it is about risk management and balancing those factors. I think also we see in Europe with close-ended funds, they don't always necessarily close when they plan to, or that they want to sell the portfolio. And it's, again, managing that risk that you want to sort of maximise the value of the portfolio. And also attracting investors as well, because institutional investors are increasingly interested in these issues and want to see you manage them irrespective of when the fund's due to close. So I think it doesn't appear to be such an issue, but on an individual asset basis it might play out of having some constraints about what you would do.
Okay. Peng Er, are there challenges that you're seeing at CapitaLand with time horizons, particularly where investors may be demanding a faster time to returns?
But of course, every investor wants a return as quickly as possible. That is always a major challenge that any developer, I think, will go through. I think the way we are doing it is think about environmental sustainability right from the onset. You must set your target right in the beginning. All the stakeholders must be involved in that process, the asset people, the building people, the design people. So once you get it right in the beginning, some items may not cost more, some items may be free. So once you start from that perspective, which is how we do it, right at the feasibility study stage. But of course, as a big company, we have the advantage of aggregated procurement. So we're able to aggregate, like for instance, LED lights. They are going to cost, and the return is going to be long. But because as a group, we can understand our portfolio of existing buildings, of retrofitting, of new projects coming online, we are able to aggregate the amount, negotiate, set standard we want for environmental sustainability, and ensure a price that we can deliver. So that's, I think, just a strategy of how we do it. And in every project, every team will use innovation and creativity just to meet that and deliver the return, because some of the technologies will take a while.
Very good. Amanda, could you give us a sense, again, from the Pacific perspective, both in terms of how those open and closed-end funds approach sustainability within their portfolios, and perhaps some of the ways that they're overcoming the challenge to maintain status as a GRESB Green Star?
Yep, thank you, Tim. I think Nina and Peng Er have absolutely covered the big issues, and it's the same in the Pacific. Time frames are important and returns are important. And if you get it wrong up front, it'll be wrong right the way through. I think the challenge is when you've got some closed-ended funds and you've got a time frame to work towards, the risk is that you run that building down so much that the quality is lost. And so I think we absolutely need to look at return on investment. I think you also need to look at yield as well. And the other metric which I think is important when you're looking at sustainability is the WALE. And what we've found is the research in the Pacific is that buildings with a better green accreditation have a better occupancy rate, and that's a compelling driver for those funds as well. But timeframes, of course, is what we struggle with most in sustainability. Interestingly, from Peng Er's statement about LEDs, what we found in Australia is that the return on investment there had been very long, but with the significant increases in energy costs, most of our big institutional clients are finding that retrofits are having paybacks within 6 months to 12 months. So it's obviously quite a different market in the Pacific.
Thanks, Amanda. Ben, I mean, we talk about retrofitting, and Singapore's regulation that requires buildings retrofitting HVAC systems to pursue Green Mark certification is a smart way to help the market move forward with sustainability, regardless of the building owner's strategy for holding the asset, as the greening part is attached to the building's life cycle anyway. But given that the HVAC system upgrade may happen on a cycle of decades rather than years, what other areas is the BCA looking at to help owners sort of address this challenge of sustainability and timeline?
I think, firstly, the way the legislation for existing buildings has been formulated based on your HVAC time frame of replacement, it's not us saying, right guys, replace your HVAC, sort it out now, throw your old one away. That's not what we want to do. What we want to do is catch those buildings at a point of major retrofit, which is usually, as Singapore's addicted to air conditioning, is when they replace their chillers, etc. So that's why we set it like that. So we understand the time frame. But one of the things that we originally did when we talk about the base building first, before we go into the tenant portion, is we had incentives, and those incentives formed a cash incentive for existing buildings, and the key component of that was to have a health check by an ESCO, which actually then looked at optimizing current systems first before you start throwing away ones which still have some life left in them. So that's the approach we always took. Now, I've got my tablet in front of me here to actually get the facts and figures as well, going back to the thing about cost of building and the payback period, return on investment. From our studies of buildings undergoing retrofit, we've found out, because we get all the cost information as well as part of our certification, that it's about $100 per square meter of GFA to do a full retrofit, which sounds quite expensive, but the payback is more than $15 if it's a normal operated building, or $30 per square meter if it's a 24-hour operated building like a hotel. So you can see that it's about 4 to 6 years to get that full payback there, and that's from starting from quite a major retrofit. So the optimization at an early stage with the systems you already have, or lighting replacements and things like that, are actually very cost effective, and your return on investment is very rapid. In terms of tenant engagement, we do have our occupant-centric schemes, which is another form of certification, and we'll come on to certification schemes, and green leasing is something else that we're looking at, as tenants have the greatest role to play. They are the lowest hanging fruit. Indeed, there are some larger kind of landlords here that we've worked with who've actually demonstrated that by working with the tenants, you have the highest rate of return, and it costs the least amount of money for the biggest effect. So there are those aspects. But looking at existing buildings, again, from the base building, we have, again, I'm having to look at this to get the details. We are targeting more SMEs now, because the large commercial buildings they've got their act together on the whole. They've got the idea, they've seen the mass, and they have the capital up front to do it. So we have a $50 million new incentive for existing buildings, and that requires 30% of its tenants who are SMEs to adopt the practices. So it does force the tenants to be involved. It co-funds retrofitting cost up to 50%, or $3 million for the building owner and $20,000 for the tenant. So there are that to help the initial capital cost to then form another driver. So we are looking at other things than purely just, right, okay, your time has come, here's a regulation to do it. So we do monitor the business cases, we do work with the professional bodies and with the larger developers to push that through, and now we're targeting the SMEs because they're the ones which, unlike the big multinationals who have whole departments dedicated to sustainability, we're having SMEs who have many hats in the same business and they don't really have the time to go into that detail. So we're trying to help make it easier for them.
Thanks, Ben. Nick, as a fund investor and in discussion with your peers, are you actually seeing that open-ended funds generally perform better on sustainability than their closed-ended counterparts? And from an investor perspective, does this matter if they do or not to the investment community? Or are investors that place significance on sustainability simply just going to invest with fund managers they know will do a good job with integrating sustainability regardless?
So short answer is that I think open-ended funds do perform better in terms of sustainability. That said, I think it's because there are structural biases that make them or that require them to perform better. By definition, an open-ended fund can take money in at any time, and likewise, an investor can take money out at any time as well. So an open-ended fund needs to make sure that they have enough liquidity in order to satisfy potential redemptions. And as a consequence, an open-ended fund is just going to need to have higher quality buildings with longer leases and stronger occupancy so that at any given moment they can liquidate a property as, and it's easier to sell a building with a long lease and strong occupancy than it would be to sell a building with 50% occupancy and something that's dilapidated. Another point I'd like to make too is that by definition a closed-end fund, normally those are value-added or opportunistic funds. So the whole question of whether that portfolio has sustainable properties I think is almost not applicable, because once a value-added fund has stabilized a property and made it, at least core-like, normally they're selling that out of the portfolio. So normally you're going to see just properties that are undergoing stabilization in a closed-ended fund rather than, the investor leaving it in there and accruing less than optimal returns on an ongoing basis. Now, do investors who care about sustainability really, will they only look at sustainable funds? From my understanding, there is a fund in Europe that, specifically in Poland, that invests only in sustainable buildings. So if there was truly an investor that only cared about sustainability, they would be looking at that fund. From my experience, as long as the fund is performing and buying buildings that will result in positive returns, as a byproduct, I think sustainability is going to be an issue in terms of helping them achieve those returns. But I don't think investors are going to just call it an end to a day if a fund's not 100% comprised of sustainable buildings.
Thanks, Nick. One of the new areas of focus in this year's GRESB survey was the recognition that green building rating systems for existing buildings generally take a different approach to those for the new construction projects in assessing management and actual performance rather than design and construction. Given that in most markets the challenge we face is making our current building stock sustainable, as we've discussed already, this is a significant step forward in asking fund managers how they're going to look at green building certifications across the portfolio. Peng Er, as a developer, CapitaLand has experience with various green building rating systems such as BCA Green Mark and the USGBC's LEED system, and both for new builds and existing buildings. What sort of practical differences have you seen between the two types of systems, new and existing buildings? And what particular benefits does CapitaLand see from certifying its assets under those existing building rating schemes?
I believe it starts from the fact that we believe that our buildings should be green, because then it will provide a better quality for our tenants. So when we started on the journey, yes, we focused on new buildings, but we always had a strategy for existing buildings. The difference is, I can imagine that any building owner, you will have existing tenants in that building. We still want to deliver that return. You have retailers who are still operating, and you want to retrofit an office building. Can you imagine the impact? But I'm glad to share our first Platinum, Green Mark Platinum, was an existing building. It was more than 30 years old, and the team worked very hard on it. I would say the difference is it's focused on energy efficiency, and that's really because an existing building will have site constraints. You're not going to demolish the entire thing. You're going to build or retrofit it, mostly the chiller. So how are you going to keep the environment still working and still deliver that return, the environment for your tenant? That is a big challenge. So I would say that's the biggest difference. But again, I think one would have to be very creative in how we take existing buildings. I think we have a case of a service apartment in Singapore, Ascot. It was, when we took it, we could have demolished it. We could have built from scratch and delivered a platinum building. But we realized it had such a wonderful history. It was built in 1950s, and it had such a historical memory because that was the period of Queen Elizabeth's coronation. So instead, we decided to retrofit it. We kept everything, and after we made it green, it actually won an Urban Heritage Award, and that became the selling point of our Ascot Raffles Place. So every project will be different. The team works very hard, engaging tenants, keeping them happy, despite the noise. But that's going to be an ongoing challenge. But to add to that, I think BCA has also worked with a lot of developers in Singapore, so we are committed to green our stock by 2020. I think we've just got a few left to go.
Excellent. Amanda, I have to be a bit careful what we say here. But the Green Building Council of Australia recently released its Green Star performance rating tool. How is that being received by the market, and what sort of transformative potential do you expect that to have in conjunction with the Neighbours suite of tools?
Thanks, Tim. Green Star Performance was released a little over 12 months ago. There's 30 projects that have been registered already in Australia, and I think that's an indicator of how much the market was looking for a performance tool. Green Star Design is the oyster shell, and Green Star Performance is the pearl in the middle. And I think that's why it's been so well received. The most efficient building you can have is an empty one that's got a great Green Star design. Green Star Performance is how to make that shell really sing. So it's, I think it's transforming the market in Australia. I think it will continue to do so. There will be teething problems. There always are with the new tools when they're released. Neighbours is the Pentium chip within that tool, so there's no there's no duplication of effort, which is very important. And I think the industry were very clear with the Green Building Council that was important right from the start. So I think that tool will be important, and I think our landlords and our building owners recognise that. Excellent.
That's great to hear. Ben, one of the strengths of Greenmark is, from a sustainability perspective, is that it's obviously it's not just focused on design and construction, and there is that emphasis on buildings recertifying and maintaining performance over the lifetime of the building, so that you're ensuring that design performance at the beginning when you're at the architectural stage is translated into actual performance, as Amanda's just said. And we're seeing other systems around the region, like the China Green Building labelling system, adopting similar approaches in terms of looking at performance after design and construction. Do you think this is going to become more of a standard practice in the industry in Asia, given that, as Ruben mentioned earlier, that the most commonly used system for green buildings in Asia is still LEED, And it's one of the issues that LEED doesn't address for new constructed buildings, is that you don't have to verify performance afterwards. So is the Asia focus going to be on verifying performance?
I think the short answer is yes, but I'll expand on that. If you look at places like you know, the EU and Australia, the green rating tools, be it BREEAM, HQE, Green Star, are very, very, very good. They're well written and they're well implemented for new buildings, and they do have their in-use or performance-based ones. But also there you have your EPCs, or which are your, you know, the energy labelling for buildings, which are mandatory, or neighbours in Australia. In this region, you don't really have that. So the green rating system itself forms that benchmarking system. So the green rating systems over here are filling that void, so to speak. So that's why there's a lot about recertification and also proven performance later on. If you look at how we do our new buildings, especially those with higher awards, we don't just go and check once it's built. We also check a little bit later, and they have to have a year's worth of energy bills, which then get translated back to their design energy model, which shows their baseline performance, etc. So you can see, and that is then normalized, because as we know, you have a building, and then your tenants come in, and then data centers come in which weren't supposed to be there. All of a sudden your building has completely changed. The economic pulls have changed. So it's very important that you do, for us especially, because we don't have things like neighbours or EPC, go back and have a look to make sure things are still operating as they should be. And then it keeps that benchmarking there. And you did bring up the fact that, you know, with the legislation being 10, 15 years before you actually retrofit, it's very important to have that, to fill the gap. That's basically the key reason why you're seeing it in this region. But the other things are also, you know, there are becoming greater emphasis on reporting as well. So we've just seen here, you know, there's a lot of reporting going on that's coming up. And without having things like neighbours EPCs, green rating tools actually help you with the reporting, because a lot of the information you put into the assessment will go into the report. And as globalization takes key and MNCs, the world's biggest polluters, are looking for mitigating or mediating their deficits, they will always look towards green buildings and having a valid green label. So this helps with them. And of course, there's also the shift towards green leasing as well, which green labels form a very easy part, because instead of saying, right, you've got all these criteria to go with, you can quite simply say, based on the rating tool, well, landlord, you need to commit to X, tenant, you need to commit to Y. That's the agreement, because you know it's going to cover pretty much all the other elements. So, yeah.
Good, encouraging signs then. Nina, in the US, last year we saw that the LEED for existing building system overtook the new construction versions in terms of annual registered gross floor area for the first time. So in the US we're seeing that certification of existing buildings as becoming more important, partly because of the slowdown in new construction there. The European green building rating tools like BREEAM also have their existing building counterparts or systems. How are we seeing those being adopted in Europe? Are they also, as in the US, being seen as the way forward in terms of greening the real estate sector? And are European investors and occupiers placing any particular emphasis on those existing building type systems?
Yeah, interesting question, Tim. I think that our experience of kind of existing building rating systems in Europe, it's quite a mixed picture at the moment. In mainland Europe, we're seeing quite a substantial growth in the use, particularly of BREEAM in use. In the UK, at the moment, there's very limited usage of BREEAM in use, and there's various reasons that if anyone wants to ask me why, probably take that outside of this. But there's a big appetite, I think, for having simple systems that communicate the performance of the building to occupiers, to our investors, that act as a proxy of how efficient that building is, what the cost of running it is, and there also you can use that to incentivize people like property managers who are working on your behalf to set sort of targets and benchmark buildings. And we do a lot of work on benchmarking our portfolio, but with actual data rather than a sort of then a star proxy for it. And I think the drivers for that are very, very strong. There are just various reasons why that hasn't sort of played out as of yet, but I think that will change over time. And I think from a sort of European perspective, one of the very interesting things is that through investor questions and surveys such as GRESB, we're being increasingly asked, what are your tenants in the building doing? Where we don't have any control over the energy use in that building, particularly kind of industrial assets or single-let offices where we don't have any involvement in the running of that building. And I think there's a lot of thought that green rating systems are a very good way of gathering that data, because it's not very meaningful to get kilowatt-hour data from your tenants because there's all sorts of inaccuracies, and it would be much easier to collect an external rating that they get once a year. Interestingly, in the UK, there is a lot of pushback from occupiers that they don't want such a rating system, which is part of the reason that it's not happened. So I think that we've seen a lot of legislation targeting landlords in the UK and Europe, and there needs to be a bit more of a push on the occupier market before we see that transformation. But I think the view is that we need rating systems, and that is the general direction of travel. It's a bit of a complicated picture at the moment. Hopefully one of the things that where they don't exist, some of the lessons learned in other markets can be reflected on in the development of systems, which I think is one of the positive things about maybe starting late in the game, that you can learn from some of the mistakes that we've probably made in the UK and Europe.
Thanks, Nina. Nick, we know from our work with fund managers in Asia that they do get asked directly by some of their investors, at least, questions like how many green buildings do you have in the portfolio right now? And if they're not a development fund, then they either have to obviously acquire assets that are already certified as green buildings or look to take a building and get it certified as an existing building. Why is it that green building certification or green building rating is so important to investors? Is it because of the convenience of benchmarking sustainability performance, or is it a sense that in some way it protects or enhances the asset value? What are you sort of seeing within your institutional investor community?
I would say it's more the latter, where it's more a byproduct or a signal that the properties that they have enhanced value. By definition, a greener building should have lower energy consumption, lower water consumption. Therefore, the net operating income you're pulling out of that building should be higher, and therefore, if you were to capitalize that net operating income, the value of the building should be higher. So I think the certifications are, they're a great thing. As an investor, we invest globally, but me in particular, we're looking at investing regionally. And so the certifications from Japan, China, Singapore, Australia are all very different. But at the very least, the certifications are a signal that in each respective market, there is enhanced value being driven from energy consumption, or less energy consumption and water consumption.
Thanks, Nick. Final question for the panel from me, and I think we can't really leave without addressing this issue because it's been discussed so much. The green leases, we've been talking about them for several years now. They are quite common in some of our leading sustainability markets like Australia, and there are some key players in the industry who've publicly adopted them as policy, like Marks & Spencer in the UK. But with one or two notable exceptions, they really don't seem to have taken off in Asia in the way that we would expect them to. Nevertheless, they're still included in the GRESB survey, and as Ruben has mentioned, they're a very important tool in terms of engaging landlords and tenants to work together. We also are aware that there are a number of big multinational occupiers who are starting to plan their own tenant-focused green lease programs around the world. Ben, I'd like to start with you. Obviously, green leases are unsurprisingly, topic du jour here in Singapore, with the release of that new toolkit a couple of weeks ago. What are the goals or expectations from the BCA's perspective in releasing those guidance documents for office and retail sectors? And what sort of reception have you received so far from the market?
From fear of being lynched from any big developers in here, I will give credit where credit is due. A lot of the big developers do already have various environmental components within their leasing documents. However, it's still not quite at the level that you could consider it being a full green lease. But there is some there. In terms of our expectations, I suppose the rationale behind producing the toolkit was, one, to make it convenient for the market, first of all. We ourselves, as the government, have a large push internally to be the leaders in the market in terms of producing the greenest buildings to stay in, retrofitting our buildings first, and only renting from green buildings as a mandate. And part of that was, as M&D, which is our parent ministry, the Ministry of National Development, are moving to a new home, so to speak, which is no longer we're owning a building, but we're leasing a building. So part of that process was we need to walk the talk, get down from our ivory towers and go, right, if we're talking about sustainability, we need to do it properly. And that means we need to be good tenants. And how do we be a good tenant? We need a landlord that is also going to be quite strict with us, so we need to set a series of guidelines. We worked with the landlord on that, and instead of not sharing that knowledge, we thought, well, why don't we share this knowledge and work with the local REITs, with the international bodies, and so getting research from Australia, dealing through their GBC with key players in Australia to give us their feedback and challenges, the same with the UK through RICS. So with that, we produced this and consulted a lot with the locals, and we had a lot of complaints about leasing is too strong a word, we're not ready, so we decided to call it a schedule, so a change of language, but it's still a green lease. So we put this online, and this is online as a Word document, so it's not a PDF, it's nothing stuffy, it's for people to cut and paste what they feel is relevant. So different buildings have different tenants have different abilities and different contexts. So we understand that key anchor tenants, MNCs, would probably be able to cover most of the leasing requirements, including certification standards should they wish. Whereas the smaller, medium enterprises, like I say, they don't really have the manpower to consider it. So we're trying to look at how the landlord then supports them, because there is such a great win-win. All the case studies that we've covered, including those in Singapore, show there is a great win-win. So we're just trying to make it easier for people. So our expectation is that we provide the tools, come and have a conversation, let's see how we can implement it. And we are having quite a lot of conversations, so in fact most of my time is actually, unfortunately Green Mark version 5 is taking a bit of a backseat as I'm dealing with green leasing at the moment. But that's our expectation. We just want to see more people start to use it, and we don't expect everyone to cover everything straight away because it's a learning process, and it would be wrong to expect that. So it's just to start implementing it. And again, like I say, the savings are there. One of the studies that we did on a real building showed that the landlord, because over here it's a gross lease, it's not a net lease. I know that in more European leases tend to be net leases, so the landlord, the tenant benefits from the landlord's cost. Here, the tenant doesn't really benefit much because they just pay a flat fee, so actually the landlord will benefit in more profit. So we're trying to address that, and what we found is if the tenants themselves, say something simple in a retail building, change their lighting, the landlord benefits greatly from the reduction in the aircon load, but also the landlord pays for the transformer losses. So they're billed before the transformer, the tenants are billed after the transformer. So you're looking at about 6% loss. So every kilowatt, you're looking at 6% of that the landlord still pays for. So you get a reduction of the cooling load, reduction of the transformer losses, landlord wins, tenant wins because they pay their lighting load. But then there's also, why not try and find ways of incentivizing a bit more, because otherwise the landlord is still the key beneficiary. So we're trying to look at ways of addressing that split. And that's where the conversation is stuttering a little bit, is recognizing that and addressing that split incentive. Even with our own building, we're still in negotiations with how do we get some rebate for the work that we're doing. But it forms that platform.
That's great, thanks Ben. Peng Er, coming to the big developers in Singapore, What sort of impact has this sort of, the toolkit, as Ben has said, has been very much an engagement tool, and it's obviously already started some good discussion around this issue, which is very much needed. So what sort of impact does CapitaLand think that this will have, both in Singapore and also in other regional markets where you're very active, and those markets often look at what Singapore is doing to see what they should be doing next as well? Do you see particular challenges, or does this really open the door for all of us in terms of a new frontier of possibilities?
Well, thanks, Ben, for sharing that. Yes, BCA did engage a lot with landlords, developers in this exercise. I think much has been talked about it over the last few days, because there was the International Green Building Conference, and my other fellow developers also talked about it. And frankly, we have to realize that tenants face some constraints, manpower alone, just to track, monitor, or even technical knowledge, and of course resources. I think that's where we were trying to understand how to help the tenants. If it's technical knowledge, that's where most of the leading developers have played their part. I think we all have green fit-out toolkits, suggested material to use. We even have in CapitaLand an InnovHub to show how you could do a retail layout in the most effective way. We can pull all the lighting consultants and give you the concepts, but there are always constraints. Each tenant is different. They may have a headquarters overseas. Manpower is really an issue. But it doesn't mean that because of these constraints, we should stop this conversation. I think the retail side has done its part. They have built a green lease for its tenants in its new properties, and for existing properties, I think when leases come up, they will talk to the tenants. This is something we are still looking at, and we're still working with the tenants, because exactly as Ben said, every tenant is different, every property is different, every country is going to be different. So I'm not so sure we can make a comment about it. Is this going to be the change maker? But definitely it's something we have adopted, and we're just going to learn from it. I hope that explains.
Thanks, Peng Er. Nick, when Ruben was going through this year's GRESB results, he mentioned there's clearly some opportunity around in Asia looking at improving our focus on that stakeholder engagement, and within GRESB, obviously, that's where green leases play a key role. As an investor, when you review the GRESB reports of the funds you're investing in, is that stakeholder engagement, particularly the green lease aspects, are those things that you pay particular attention to? And if they are, why is that?
To be honest, there's not that much information on green leases coming out of our fund managers. As someone who previously worked at a fund management company doing direct investments, I think green leases are atypical in most parts of Asia outside of Australia. The guys who probably do have some green lease terms would be tenants from Australia, or the likes of Lendlease and other Australian developers that have buildings and properties and developments in other parts of the APAC region. I think there are certain cities in Asia that do not help in terms of getting green leases implemented, in that standard lease terms are 2 to 3 years, so there is less incentive for a tenant or for a landlord to work together on a medium to long-term basis to implement sustainable lease terms. So I think as going forward, landlords and tenants, one of the things they could do is start talking more about having long-term leases, and that's something that does exist in Australia. In the US, there are lease terms that are 5 to 10 years. I think the guys in Asia that do have long-term leases or are doing build-to-suit properties are more likely to have green leases, but just given the standard market lease terms here in Singapore, China, Hong Kong, 2 to 3 years is an obstacle, and realistically, for a landlord to say, I'm going to put in $10 million to upgrade my building, and I'm going to have to like amortize that cost over 3 years. It's going to, you know, hit the income statement pretty hard. So there are significant obstacles, but they're not insurmountable. It's just going to take some time.
Thanks, Nick. It's a very good point. I won't go back to the landlords on that point, but wrapping up, Amanda and Nina. Nina, I mentioned Marks and Spencer's earlier in the UK, where now all of their new leases are going to be green leases. Are you seeing a lot more of that tenant side green lease clauses becoming more common in the UK or Europe? And are green leases generally becoming more common amongst the landlords? And if not, what do you see the reasons behind that being?
Yeah, so ourselves and a number of the other large landlords in the UK signed green leases with Marks and Spencer's on a number of our existing leases, and going forwards they're rolling that out as standard. They're actually probably, most of the large UK landlords, ourselves included, now have standard, what I would call light green clauses within our leases, so around cooperation, data sharing, working together. Nothing very sort of tough. There's no kind of penalties for not doing it, so very on the light green end. In general, they're accepted by our tenants. It's very unusual for them to get struck out now, because I think the lawyers are getting very familiar with them. There's a lot of toolkits out there and training that's been done, and I think that's reflected on the fact that they now tend to get accepted and not struck out. From our experience of having all of those signed, my personal point of view is I don't think the lease is the place to drive innovation and change and cooperation and really anything very interesting with your tenant. So you can put these clauses in, and that certainly doesn't guarantee any behaviour change whatsoever. So you have to have all the programs that sit behind that actually guarantee ongoing engagement on the ground. And the lease doesn't really do much around that. It sets a framework. I think our view of where things will move in the UK and Europe is the standards will become tough within leases, but it will be around things where we are using the lease to make sure that we have either legal compliance or above and beyond that. And anything around kind of more collaborative work, it's just not the place within a lease. And I think also we have to be a bit reflective that in certain markets we're trying to see simplification of leases and trying to take out anything sort of not needed in leases, and we've got to be careful that you don't have a whole load of environmental clauses in there that sort of goes against the general principle of simplification, that you're trying to make this process sort of simpler for landlords and tenants. So in my view, I think you'll see more standards and targets in leases, but it will be within a fairly simple framework.
Thanks, Nina. Amanda, how does that view from the UK resonate with what you're seeing in Australia, where, you know, as we've been talking about, green leases are very perceived to be very common? Are you seeing similar challenges around lack of strong wording, lack of penalties, and where do you think the sort of future of the evolution of green leases in Australia lies?
It's very similar to Nina's experience, and the nature of a lease is that it's not dynamic until you're signing it and renewing it, and that's where the rubber really hits the road with leasing strategies. Of course, the government in Australia has the requirements for green lease, and that's why we're kind of held up as champions of green lease. The reality is not the rest of the market have a strong commitment to green leases. About 35% of the Sydney CBD, the Better Buildings Partnership, have just done research in that space, and we'll be releasing that in the next few weeks. There's not a lot of teeth in those lease clauses, but it allows a conversation. I think what will be the shift in those lease clauses having more teeth is the realisation just recently from the neighbours data that a lot of our institutional clients have beautiful portfolios of 4.5-star neighbours ratings. They'd like to get to 5-star, they can't. The neighbours data has shown that tenants impact at least at a minimum of 40% of that neighbours result. So that is when we're starting to get requests from our clients to assist them in having that conversation with tenants around we'd like you to join in on this party. You're in a great building and we'd like you to be part of that conversation. So I think there will be a shift coming in Australia where we'll see more teeth. Interestingly, in Australia, and not dissimilar, I think, to the other markets, we're finding green leases coming from tenants less than from landlords.
Thank you, Amanda. I think we have 5 minutes if anyone has any questions from the audience for our panel. If not, I think we've covered a lot of ground today. Obviously still a little bit of a question mark over the issue of green leases, but nevertheless I'm sure the conversation will continue. I'd like to thank Peng Er, Nick, Nina, Amanda and Ben very much for joining us today and sharing their experience and views on some very interesting topics, so thank you. Just